Hello investors, welcome to Simpli Stocks. Today I will be discussing a very special microcap business from my watch list. We have covered several interesting microcap businesses in the last 2 weeks, but some very interesting things have happened in this particular company recently and it has rallied quite a lot too. Therefore, we have brought a separate detailed analysis on it today. The company we will be discussing is Unihealth Hospitals. We have been tracking this for a long time in our Simply Stocks community, and we also covered it on our Simply Stocks channel at the end of August, I think. Their results have been very good. Unihealth's new hospital in Navi Mumbai has started operations and it has rallied quite a bit lately. So a separate detailed analysis is definitely warranted. In today's video, we will again go over Unihealth's business model in detail. We will talk about the opportunity and their expansion plans as well. Along with that, we will also look at the risks associated with this business and perform a simple valuation that you can do with any growth business. But remember, this video is in no way a buy or sell recommendation on Unihealth. You must keep that in mind as it is a very small and risky business. With that being said, let's begin. Unihealth is from the healthcare sector and it is in the business of running hospitals, medical centers, and medical camps. They have a 120-bed hospital in Uganda and they recently commissioned a 52-bed hospital in Navi Mumbai. They also have an 80-bed hospital in Nigeria, but it is not doing well for now. Nigeria's contribution used to be higher in their sales, but its currency has devalued. No improvement is expected there and they will also gradually exit from that market as well. They also have a 20-bed medical center in Tanzania, but its contribution to their business is negligible. And this 52-bed hospital in Navi Mumbai has been commissioned very recently in October. So it currently has no contribution to their business as well. It takes time to bring patients and generate sales in a new hospital. For now, 90% of their sales come from that sole 120-bed hospital in Uganda. The remaining approximately 8 to 9% share in the April to September period was of the export and distribution business of pharmaceuticals and medical consumables, where they supply medical products to other hospitals and healthcare companies. Now, the trigger in Unihealth is that this company is expanding very rapidly on a very small base. For instance, for now, their entire business is dependent on that one particular hospital in Uganda. But their 52-bed hospital in Navi Mumbai has just started in October and they are setting up another large hospital in Nasik with 120 beds capacity, which will become operational at the beginning of FY27, meaning April or May next year. So you see, their business is about to triple in the next 5 to 6 months. They will jump from 120 bed capacity straight to 372 bed capacity. And after Nasik, they plan to set up a third hospital in Pune with 125 plus bed capacity. In the medium term, their goal is to reach 500 to 600 beds capacity in India in the next 2 to 3 years. This seems quite achievable because when you add both Navi Mumbai and Nasik hospitals, their capacity is already at 252 beds. In Africa too, their goal will be to add more than 400 new beds in the next 2 to 3 years. So with 500 to 600 beds capacity in India and 400 new beds in Africa, their total target is to add 1000 to 1100 beds capacity in the next 2 to 3 years. You see, the company is currently operating with just 120 beds capacity in Uganda, but they plan to expand this tenfold to over 1100, 1200 beds in the next 2 to 3 years alone. This will also diversify their business and reduce the overall risk because where Uganda currently brings around 90% of the sales, going forward, India will contribute 40 to 50% and Africa will contribute an equal 40 to 50% in revenue. We have been tracking Unihealth for a very long time now, but it has recently come into focus because their results were very good. You will see in this screenshot that in H1 or the months from April to September, their sales have grown by 54% over last year. Sales in the first 6 months of the year reached 67 CR and net profit has straight up tripled from 9 crore last year to 28 crore. Since profit growth is higher than sales growth, we can also say that company has achieved very good operating leverage too. You can understand operating leverage like this. See, hospitals or hotels are your asset heavy businesses. Whether 100 patients come or 200 patients, the cost of running your hospital remains almost the same. The salary of the staff or the expense of the machines that you have installed, everything remains the same. In such a scenario, if your break-even point is at 150 patients, a no profit, no loss situation at 150 patients, and 50 patients come above that, your profit growth will be very high, because 80 to 90% of that incremental revenue above the break-even point will convert into your profit. Because of this, you will see a very good expansion in the EBITDA margin. The EBITDA margin has jumped straight from 38% to 50%, and the net profit margin has increased from 11.5% to 22%. This is a plus point in this business. Their Uganda hospital operates on very high margins. Now, before we move forward, a humble request: if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simply Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel. Coming back to our discussion, besides operating leverage, another reason for such good sales growth and margin expansion is that ARPOB of their Uganda hospital has improved significantly. ARPOB, or average revenue per occupied bed, means how much you are able to charge from your patient per hospital per bed per day. Until last year, this used to be 24 to 25,000, which has now jumped straight to 40,000 in this H1. This means a 60% growth has been seen in ARPOB alone. The reason behind this, as the management explained, is that they have added super specialty treatments such as IVF, spine surgery, etc. Besides this, they have also added ICU beds there. In this way, they have been able to give more special and costly treatments to their patients and charges them more, obviously. For example, they are organizing surgical camps there, where they are sending doctors from India to Uganda. The flights from India take about 5 to 6 hours. And this is also a special thing about Unihealth business. In H1, a spine surgeon from India went to Uganda every 1.5 months, which helped them to grow their spine and ortho departments and increase sales from there. Similarly, when their hospitals in Nasik and Mumbai will start running well, they will refer patients from Uganda and other African countries over here if more serious treatment is needed. This is part of medical tourism only, and here they will get better margins. Now, if we summarize, Unihealth saw very good bottom line growth due to ARPOB growth and operating leverage. Now, a very important thing you need to understand here is that the recent rally in Unihealth has nothing to do with their India business yet. I have often seen that when a business rallies too much in such a short period, people start to run away from it, no matter how good the business is. Look at it this way. Last year, Unihealth's entire net profit for the year was just 15 CR. Now, in H1 alone, Unihealth has earned double of that, 29-30 CR approx in profit. What has happened in this situation is that your PE ratio has adjusted very quickly. The market has reacted to this. But even after such a rally, Unihealth's valuation is still very attractive. I have an old screenshot of screener here. In this, you will see that even 3 to 4 months ago, Unihealth was trading at a PE ratio of just 17 to 18. Good results came, it rallied, but this business is still trading at around 21-20 PE. There has not been very big shift in valuation. Their Uganda business has done very well, which is why the stock is in focus. The Navi Mumbai hospital has just started in October. Therefore, the journey of the India business, which is their main trigger for Unihealth's long-term story, has not even taken off properly yet. Here, let us also do a rough valuation exercise for Unihealth. Their profit in H1 was about 30 CR on 17 CR in sales. If we assume that the same 30 CR profit on 17 CR in sales will come in next 6 months of the year as well, then their total annual sales can be around 140 CR at least, and net profit would be 60 CR. The company's market cap when I was shooting this video was 500 CR. So based on this year's estimated profit, Unihealth's forward PE comes out to just 8 to 10. You see how cheap this business is on its forward PE even after such a sharp rally. And the main growth is yet to come. And this is just about this particular year. If we take estimates for the next year, the management has said that their Navi Mumbai facility has already started and Nasik will start in Q1. And from Q2, meaning July and August, it will slowly pick up. So for the next year, meaning FY27, the management is aiming for a total sales target of 125 CR for the both Navi Mumbai and Nasik hospitals, or basically India business. And we just saw where Uganda business is bringing in about 140 CR in sales annually. On top of that, the management has said that they will further grow the ARPOB of the Uganda business, which has increased from 25,000 to 40,000 to 55,000 and even 60,000 next year, which translates to another 35 to 50% growth for the Uganda business alone. So their Africa business will bring in about 200 CR in sales in FY27, and the India business will bring 125 CR. Thus, their sales in FY27 can be around 300 to 325 CR. So as Unihealth is currently at 140 CR in sales, it has the potential to more than double its sales in the next 1 year. You are getting a business at a PE of just 8 to 10, which has potential to double its sales next year and grow its business tenfold in the next 2 to 3 years. Let us assume the management misses these targets a bit and they don't reach 1000 beds on a consolidated basis. They max to max reach 700, 800 beds. Even then, this business will generate very good growth. And their management is also quite clear and focused with their strategy. You will see that large and famous hospital chains like Apollo and Sahyadri run hospitals with a capacity of over 200 beds. Their hospitals are big in size. People go there because they trust the brand rather than the doctor's name. But Unihealth's target is to open small hospitals in the range of 50 to 175 beds, where they will provide treatment and care to the patient with a personal touch. You won't find this in large hospital chains. So this will be a big USP for them. But every good business is not just as good. So what are the risks in Unihealth? Well, in their Uganda business, the payment cycle is very long. Most patients there come from the Uganda army. So the Ministry of Defense of Uganda is their main customer and they process payments after 9 to 12 months. They take up to a year to clear payments. This is a very big disadvantage in the Uganda business. As of September, when their H1 ended, they have 112 crore outstanding that needs to be cleared. You see, the company's market cap is itself just 500 CR and 112 crore money they have earned so far is yet to be recovered. This is a big risk that can play out if there are geopolitical and economic tensions, as we saw in Nigeria. But the management's take on this is that as they will introduce super specialties, their payment cycle will improve because most of the patients there are cash paying. Similarly, the ministry has also slowly started making payments on a bulk basis, on a quarterly basis. So some easing of the payment cycle is expected in the future. But on the other side, they also get two advantages in Uganda. Firstly, you saw that the margins of the Uganda hospital are very, very good. And secondly, they have a tax break for 10 years until 2034 on their income, due to which they do not have to pay income tax there. So the net profit margin will remain high. Another risk is that even though the H1 results are very good and the management commentary is also very strong, you should not ignore the point that a company is still very small in size. Their first hospital in India has just gone live, and that to a very small 52-bed hospital. So the management will have to prove itself. Going forward, we will have to track closely whether they are able to bring patients to their hospitals or not. And when their 200-bed facility goes live in Nasik, then we will have to see how quickly they are able to bring patients there. Because of this, I keep saying that Unihealth's recent results are very good, which is why this business has rallied so much. But its true story has just begun. From here to Unihealth has a lot of potential to grow its India business by launching more hospitals in India. So Unihealth is a good business which is growing very fast on a small base, which you can study yourself once. Now, if you like this video, do give me a thumbs up. A lot of work and time went into making this video. If you support us, we will be able to bring more such videos every week. You can also subscribe to our channel, Simpli Stocks, where we bring multiple such videos every week. I'll see you in the next video. Happy investing.